Another timeline that other people ask about is a remortgage. Let me explain what a remortgage is. I was speaking to a client today who is, a first-time buyer, very intelligent individual, and she said, "Anthony, could you just explain what a remortgage is?" After I buy this property in X amount of years, when my fixed term ends and I want to remortgage, what exactly is that? She even asked me about what happens when she sells. But let's first talk about a remortgage. So when you're taking out a mortgage, there's two terms or periods that we look at. We look at the overall term. So that's usually the long number. That's the entire time that it would take, and we're talking about repayment mortgages now. That's the entire time that it would take to fully pay off your mortgage. So let's just say you take out a mortgage with a term of 30 years. That means from the moment you get that mortgage, over that 30 years, you'll pay down the mortgage. At the end of 30 years, you'll have a zero balance. You'll own the property outright. Wow, that's a great feeling. But within that, most people will have what's called a fixed period or a fixed term or a benefit period. This is usually 2, 3, or 5 years. You can do it 1 year, a 5 year, a 7 year. There's other ranges, but most products are grouped at 2 years, 3 years, and 5 years. I like to talk about it as short, medium, or long term. Why would someone take a 2 year fixed? If you feel that the interest rates are going to be going down in the short term, then quite often you would want to get a short fixed period. The great thing about the fixed period is that you know how much you're paying every single month for that fixed period. However, there's something called fixed rate risk. So the fixed rate risk essentially means if you do a longer term, let's just say you do a 5 year fixed rate. On the upside, you know exactly how much you're going to be paying for the next 5 years. However, if interest rates drop within that 5 years and you want to take advantage of that, you're unable to unless you pay an early repayment charge. So, yes, you can fix it. And when you're speaking to your mortgage broker, quite often they'll give you some guidance. But always remember, none of us know what the future will hold. So, we can give you some guidance. We can tell you what other people are doing. And potentially, you might find that a 2 year fixed is less expensive than a 5 year or vice versa. But ultimately, you need to decide what you want to do. We will advise. 2 years can go really quickly. So for some people, they say, you know what? I'm willing to take the risk and do 5 years because you move into your property and before you know it, you're looking to remortgage, which is what we're talking about right now. So at the end of that fixed term, whether it be 2, 3, 5, or another range, at the end of that term, if you have a fixed rate, that fixed rate ends and you go on to what's called a standard variable rate or SVR. The standard variable rate is exactly what it says in the name. It's variable. So at the end of that fixed term, you will go on a standard variable rate. When you go through your illustration document, it will give you a guide of what it would look like, but that's a little bit misleading because nobody knows 2, 3, or 5 years from now what the rates will be, and therefore you don't really know what the standard variable rate would be at that point. So most people at the end of the fixed term, they look to do something called remortgage. So that means you have if you remember the original illustration we went through was, I think it was 25 years. So you took out a mortgage with a term of 25 years. Let's just say you took a 5 year fixed. 5 years from then, you would, in theory, have 20 years left. However, when you remortgage, you are starting a new mortgage to a degree. So what you could do is you could remortgage and do it over another 25 years. You could do it over 10 years. You can adjust the term when you remortgage. The great thing about remortgaging, especially if you've had a large deposit and or your property value has gone up. So you have additional equity. And remember, equity is the difference between what your house is valued and how much you owe. If you have additional equity in your home, there's lots of things that you can do. You could release some of that equity, which is a further advance. You could go on to a new mortgage, but now because your loan to valuation may put you into another threshold, you may find that your payments are considerably lower. There's so many things you can do, but just view the remortgage as kind of starting over, but you've already gone through the process once. So one of the things that you want to consider when you're thinking about potentially remortgaging, always go to your existing lender first. What will usually happen is 3 to 6 months before your fixed period ends, your current mortgage lender will send you a letter saying your mortgage is ending in X amount of months. This is what we can offer you. So look at that figure. That's the figure that you will take to a mortgage broker or bring to me and say, look, my current lender is offering me X. That way we can explore and see if we can do a better deal for you. But remember, when you remortgage, if you go to another lender, then you're going to have to go through the process all again, and that might be tedious. And this is why you have to consider, have your circumstances changed? Let me explain what might be really positive for you, especially if you're someone that had to go to a specialist lender to get your initial mortgage. Let's just say you had credit issues or late payments, missed payments, something that prevented you from going to a main street lender that's offering the best rates for vanilla clients. If at the point of remortgage, you've paid your mortgage well, you've never missed a payment, you've managed your finances really well, you may find that now you qualify with one of the high street lenders because initially you had to go to a specialist lender due to credit issues. So now, when you're looking to remortgage, it might not be in your best interest to stay with the current lender because they're a specialist lender. So they are people that help people get back on track due to credit issues or other circumstances. So in this case, you might find that by going to another lender, you're going to get a better rate. And if the rate is considerably better, it may mean that you can reduce the term on your mortgage or you can release equity. There's just so many things you can do. So always first see what rate your current lender is offering you, then speak to a mortgage broker and consider, have your circumstances changed? The opposite could be true as well. It could be a circumstance where initially you had good credit, but now you have missed payments or things of that nature. In that case, you may just want to stay with the same lender because you might find that other lenders aren't going to do the remortgage for you. So that's a quick overview of what a remortgage is, why you might need or want to remortgage, or why you might consider staying with the lender that you. Either way, make sure you speak to a broker. That broker will be able to give you good guidance, good advice, and compare the market for you. So the benefit of going to a broker is not just talking to one lender. Brokers have access to all the lenders, different products, different services, and can cater the lender to your needs.